Interest rates, the Federal Reserve, recession, stock market overvaluation, sectors of the market that may be undervalued, all that and more on this month's monthly economic update. Interest rates, the stock market, the Magnificent Seven. What has the month of March brought us? Hi, I'm Dean Barber, Managing Director of Modern Wealth. Welcome to our monthly economic update. Let's start off with talking about interest rates and the Federal Reserve and the housing market. So, the Federal Reserve hinted about a week ago that they saw 3 rate cuts in the future. And as we look at the economy as a whole, things look really solid. We've got low unemployment, corporate profits seem to still be really good, but there's some cracks starting to show in different parts of the economy. So that's why I want to tackle interest rates and the Federal Reserve here at the beginning. When we look at the housing market in general, total spending that is tied to the housing market and activity in the housing market in 2021 accounted for about 16.5% of the total GDP of the United States in 2021. What we're seeing happening right now is that mortgage applications for new home purchases are down 16% year over year. So it takes some time for that action that's slowing down in the housing market to leak into the rest of the GDP, but I think the Federal Reserve sees that. At the same time, we're seeing delinquencies increase both on personal credit cards and on automobile loans. So those things left unchecked, leaving interest rates too high, could force what nobody wants to see, and that is a recession. So we do believe that there will be some tightening some loosening of monetary policy later this year. There's 6 more Federal Reserve meetings this year, so it remains to be seen exactly what's going to happen, but we're going to be watching that very closely. As for the equity markets, let's take a look here for the month of March. You have the S&P 400 midcap leading the charge. I will tell you, this is the first time in a long time that we have seen mid-caps leading the charge. Mid-caps were up 4.53 for the month of March. And the beloved darling of 2023, the NASDAQ 100, was in second to last place, up only 1.55% in the month of March. And I purposefully highlighted the NASDAQ here because remember, the Magnificent Seven was driving the vast majority of the returns in 2023. And we started to really see that broaden out where those 7 aren't necessarily the ones that are making up the returns of the market. And that's a good sign. And what's driving that is the anticipation of the Federal Reserve cutting rates. So if we look at the Magnificent Seven here, Microsoft, Apple, Nvidia, Amazon, Meta, Avgo, Tesla, those particular companies make up 40% of the NASDAQ 100. And you'll remember that the NASDAQ 100 was up significantly more than any other index last year, but those 7 are no longer the driving factors. Take a look at the S&P 400 midcap. Well, what are our top 7 here? Do you even recognize any of these? And look, they're not overly weighted anywhere, so that entire mid-cap sector has really started to perform well. We're seeing the same thing in the S&P equal weight, which is equally weighting the amount of investment in all 500 companies, that versus the S&P 500, so slightly above. We haven't seen that happen. Remember, we started to see that. I pointed that out in my December video last year that we were starting to see a broadening of the rally in the market. That really continues across the board. It's easy to see when you peer in and take a look. Something else that's interesting right now is the price to earnings ratio. Price to earnings ratio on the S&P 500 eclipsed 27 here this last month. That means that on average, the stocks that make up the S&P 500 cap-weighted index are trading at 27 times next year's earnings. That's pricey. We strip out the Magnificent Seven or we even go to the equal weight, that PE ratio is all the way down around 15. So you could say that there are still a lot of companies out there that are fairly valued or undervalued. And so we knew last year when we saw such a narrow growth in the market that either those the Magnificent Seven was going to reverse course and come back down, or the rest of the crowd was going to have to come back and start to catch up. And what we've seen happening is, with the talk of the Federal Reserve and the possibility of lowering interest rates in the future, the rest of the market has started to take over and really dominate the performance of the overall sectors. Let's take a quick peek at interest rates and the Treasury yield curve. Not a lot of change here over the course of the last month. We still have the 3-month Treasury hovering around 5.4%. The 10-year Treasury is kind of range bound, stuck in that 4.2 to 4.35 range. So not a lot of movement there. The yield curve and the Treasuries didn't rally like the rest of the market did when Jerome Powell said that he thought he saw 3 rate cuts in the future. So I still think there's room there in the fixed income market. All in all, we see a healthy economy. We see the broad market fairly priced, some parts of the market underpriced, and then there are still those parts of the market that are overpriced. So hopefully that helps you understand what we've seen happen during the first quarter of this year. Hope you enjoyed this. If you did, please share it with your friends. And until next time, everybody stay healthy and stay safe.